Hey, good morning once again, options traders, and a happy Friday to everyone. I hope everybody's looking forward to a fabulous weekend. And we've seen a pretty dramatic fall in the volatility of the markets as measured by the VIX, or the volatility index. And I've had some traders saying, well, I had some neutral trades on. Perhaps it could be a butterfly spread or a condor, or maybe even just naked positions. And they say, well, that's actually a good thing because it makes it more likely for the stock to stay still. Well, is that really true? Is falling volatility good for neutral trades? So for example, you can see that on March 8th, we hit a peak pretty close to 38. And then lately, just on this big waterfall, this big landslide, and then on today, March 21st, closed at about 23.5. So this is what the traders are looking at. They're watching it come crashing right below the 50-day and all the way down to the 100-day and thinking that that's a good thing for neutral positions. Well, on one hand, it can be, but remember that when one thing changes in an option, it starts wheels in motion, and that can change other factors, other Greeks that you might be unaware of. So is this really a good thing, this falling volatility, for neutral trades? Well, to make the point, I'm going to use a butterfly spread, which we've talked about in many videos before. But recall that a butterfly spread is a strategy where you might buy a single call option, sell two calls at a higher strike, and then buy one call at yet an even higher strike. So it's in this succession of 1 to 2 to 1. And sometimes you'll see it written this way as 1 to -2 to 1, just as a reminder that a long butterfly means that you're long the first strike, short the middle two, and then long the third. Now, of course, we could create butterflies with puts. We could also do them with combinations, which would be a short iron butterfly. But regardless of the way that you construct it, they have the same general shape. So it's going to apply to any type of a neutral spread, or in this example, we're just going to stick with the butterflies. So with a butterfly spread, they also have to have the same expirations and are generally equally spaced. There are versions that are not equally spaced that are called broken wing butterflies, but we're just going to stick with the basic equally spaced butterfly. So as an example, you might buy one May $95 call, you would sell two May 100 calls, and then buy one May 105. So once again, notice that we are in this 1 to 2 to 1 ratio. We're long this first strike, we are short two of the center strike, and then we are long this third. Well, when we do that, it is a neutral spread, one of many types, but the butterfly trader wants the stock to sit still. Now, this is also assuming that the butterfly was initiated when the stock was at the center strike. There are also versions called bull and bear versions where we could adjust that center strike. But generally speaking, a butterfly is considered to be a neutral spread. So the question that we're trying to address, again, is falling volatility good for the trade? So once again, just for this video, I'm going to stick with a butterfly spread, but the principles I'm about to show you apply to all neutral positions. So here's our butterfly spread at expiration, and we have a bend at 95, we have a bend right here in the center at 100, and we have another bend at 105. So as I point out pretty much in all of the videos, when we're looking at the expiration graphs, we always get a bend at a strike. This is where our hedges are coming into play. Now, a lot of times traders like to do butterflies maybe in a relatively high volatility environment because synthetically this is the same as a short straddle right here in the center. And that has a very high probability of expiring, not necessarily worthless, but expiring for less money than the credit you received. So it's a very popular strategy, especially when volatility is high. If the stock gets above this upper wing right here, this upper strike, we take the maximum loss. If it gets below this lower one, we also take the same maximum loss. In this example, it cost us $1.60 for the butterfly, and because it's a 5-point spread, that's just the difference between these strikes, we could make the balance of $3.40. And you can see right here at the top, lining up at $3.40. So today, though, this butterfly spread is not going to look like this. Remember, this is the expiration graph. So today, under high volatility, it might look like this. And you can see why the trader wants it to sit still. If the stock stays still, This blue curve in the center is going to start rising up towards the top. And of course, these areas out here are the danger zones. So when you have a fairly high volatility environment, your potential for the upper prices here or the lower prices starts to increase. And so traders are focused on this, thinking, hey, this is potentially very dangerous, that the stock could either take a pretty good hike up or down and put me into the maximum loss. Well, that's true. And on one hand, you could make the argument that the high volatility is not ideal for a neutral trade, especially if the stock is right here in the center. But that doesn't necessarily mean it's a good thing for volatility to fall. Why? Well, remember, as I've also talked about in previous videos, that volatility and time have similar effects to any strategy. They affect it to different degrees, but you can conceptually think of them as the same thing. So in other words, we could have a high volatility environment and get this blue curve, or we could have a low volatility environment, but just make the trade with a longer expiration. And we could get exactly the same thing. Because in either case, increasing the time or increasing the volatility, you're giving the stock price more chances to move. So therefore, if we reverse this, we get the opposite. We start heading towards the black, and therein lies the danger. So most people know that as time to expiration starts drawing closer, that this blue curve moves towards the black, but they don't think about that for volatility. So if this is your trade when you first put it on and you're watching that volatility collapse, you're going to move from the blue to this red. This is the identical strategy, just with lower volatility. And what's the danger here? Look at the curvature. You see how this blue curve is fairly gentle, sloping right through here? Fairly smooth. Look at this, is becoming more of a point in red. That's a lot more curvature there in red. And that means we have more potential price risk if the stock rises or if the stock falls. So you don't really have that here in the blue. With the stock at 100, in fact, you can see if it falls to 95, there's not a real big difference in those prices. It's fairly flat. But look at that from the red. If you move from 100 here in the center to 95, you move from this upper value here, looks like at about $1.10 or 20 or somewhere, all the way down to break even. And that's because you've got this very large curvature to the position, or gamma. So that's really the main thing I wanted to point out in this video, that when you see volatility falling, it's not necessarily a good thing for your neutral strategies. It creates a different risk, and that risk is gamma. So how you would hedge that or morph this trade to account for that is a subject for a different video. But for right now, I just want you to realize that anything that happens in the markets, stock price up, down, the volatility up, down, doesn't matter. It's always going to create potentially some good scenarios and also create potentially bad scenarios. And you need to know how those variables are going to affect your strategies. Otherwise, as I always say, you might end up being right about your outlook on the stock and still lose on the trade. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, join us on the YouTube channel, Options A to Z Facebook Trading Group, and you can find a link in the description below.